Hi, everyone, and welcome to today's presentation. Today I'm going to be talking about generating high probability above average returns through hyper options. This is a strategy that is considered to be the most reliable way to consistently beat the market with substantially less risk. And in fact, if you're looking for consistency, if you're looking for high probability trades, if you're looking for above average returns, trades that are super easy to execute, a strategy that provides diversification and crash resistant opportunities, then Hyper Options is for you. Hi, everyone. My name is Ryan Jones, and I'm here to talk about one of my favorite approaches to trading. It's probably one of the strategies that I have the most experience with. It's one that I've started many years ago. The logic behind this, and I've got a lot to cover today, so I'm just going to get right into it. And I'm going to start with my 20-second elevator speech or explanation of what exactly hyper options is, and then you're going to want to stick around because what I have to show you, it's really quite crazy, actually. So here's my 20-second elevator speech. Hyper options is a high probability exact entry and exit signal service designed to give traders of virtually any account size the ability to generate above average returns with significantly lower risks over standard buy and hold stock investments. In a nutshell, that's what hyper options is all about. But more importantly, hyper options delivers a much smoother equity curve in the process, and it is crash resistant. And I'll talk a lot about that here in a few minutes. But the logic behind the hyper options approach produced a 5-year winning track record. Actual trades, when I was providing signals for the same type of approach several years back, it had an actual winning track record of 94%. And in fact, in one of those years, it went an entire year without a loss. It generated 57 winning trades in a row without a loss. And the current streak is at 28 winners in a row as well. So it's doing really well right now. Of course, stocks have been up, and I'll talk about all of that and what the probabilities are long term and how to establish sometimes an ultra high winning track record. So what is the secret behind an ultra high winning track record anyway? Well, I'm going to get into a little bit of the details here because I want you to understand what we're doing. I want you to understand the sound logic that is behind this and why on an actual track record it can produce a long-term 93, 94% win rate and go on some incredibly great winning streaks. So here it is. Number one, I'm going to sell puts in stocks with low probability of reaching the strike within the allotted time based on 3 factors. All right, so I'm selling puts in certain stocks that have a low probability of seeing the price of that stock move down to the strike that I'm selling within the time or prior to the expiration of the particular option that I'm selling. It's really logical. The question is, which ones do you get into? And that's where people aren't quite as sure because there are obviously a lot of opportunities out there. But what you want to do is you want to pick the ones that give you the highest probability of success. And so these are 3 basic principles that I apply when I'm looking at a particular opportunity. So the first one is the current price of the stock relative to the history. Where is the current price relative to where it has been over the last 3 to 6 months, maybe 12 months, and then make an assessment based on that. The second one is the ability to resist a crash, the ability to resist a crash. And I'll get more into that here in a second. And then third is the option prices relative to the strike price. Those are the 3 main ingredients to my decision-making process of how I pick the highest probability trades out there. And so I'm going to use an actual stock that I'm fairly active in, actually really active in. And I'm going to go through and I'm going to show you basically at what point I'm going to start looking at possible trades with this particular stock. Now you'll notice that this stock is The stock price is not very high. It's actually a $12 stock. And what I do is I generally do not sell puts as a market is surging. I know that goes counterintuitive to what a lot of people like to do. That's fine. But what I want to do is I want to stay away from the retracements. And so you'll see there where the red arrows are, and this particular stock was surging, and then it started coming down. Well, during the surge, I don't want to sell puts during a surge because that just means that there's a higher probability that any retracement can actually bring my trade into some sort of danger. So I don't do that. Instead, I wait until the market is relative to where it's been, is not making new highs as a general rule, and has come into a range of trading. I also don't want to sell puts necessarily when the market is tanking. I want to wait until a certain point of either it stagnates or it hits a support area or something like that. And so it's there's not a lot of detailed technical. It's really a matter of, is it a good deal or is it not a good deal? And it's really a matter of, yes, this is a stock I would sell right now, or a stock that I would sell puts in right now, or it's not. And it's just a yes or no, yes or no. And so in this particular example, it's yes, as it's moving down into this congestion area. So anywhere where you see the blue arrows, I'm going to be considering selling a put in there. Okay, so that's the stock price relative to its recent history. The next one is the ability of a stock to resist a crash. Now, part of that has to do with where it is relative to its history. If it just went through a crash, it is less likely to crash an equal amount. And so this is kind of what you see here. You see like a surge in stocks, and then you see a mini crash, and now we've leveled out here. And so what I do is I look at that, and then I also look at where the strike price can be, and I create a strike zone, if you will. And the strike zone is going to be either near the long-term lows or below the long-term lows, or it's going to be at least a minimum 25% away from the market. And actually, it has to be and. It doesn't have to be near the bottom of the long-term lows if it's still 25% away or more. So if it's still 25% away, then I'll do that. What I won't do is if the strike is near the bottom of the long-term lows, but that is only 10% away, right? So I do have a minimum overriding distance that the strike needs to be away from where the market currently is, and that's where I'm going to sell the strike. And then the final thing that I look at is whether the business is long-term resilient. I'm not necessarily, if I want to produce the highest probability trades that will have the highest probability of resisting a crash, then I'm going to stick with businesses that have a long-term resilient track record. Now, that doesn't mean that there aren't some really great trades in other stocks that may not be as resistant to a crash. But as far as the hyper options and what I'll talk about here in a minute, the hypersonic options, that is a consideration that I look at. And so this particular stock, again, this is not a no-name stock. This is a very, very well-known stock that I get into. And here are the last 3 trades in this stock that were taken. Actually, the first 2 that you see, the $9 puts, have been exited. The last one is a $7 put, and I'm currently in that one right now as we speak. And so what I want to point out here is the option price relative to the strike. And my minimum, again, is at 2%. If I can't generate at least a 2% premium in the option that I'm selling relative to the strike, not the current price of the stock, but relative to the strike that is in the strike zone, then I'm going to consider it as long as it's 2% or more. I won't consider it if it's less than 2%. And so you can see here the $9 put, which was which was sold when the market was somewhere around 1280, 12 between 1250 and 1280. The $9 put was sold for 38 cents, and it had 57 days left on it. Well, if you take a look at that, that's 38 cents is a 4.2% of the strike. And so that's well above my 2% minimum. The second $9 put was a little bit longer term, and it was sold for 69 cents, and that one was for 85 days. And that particular stock or that particular trade was 7.7% of the strike. And so you can bring in more money if you want to go out a little bit further in time. I don't want to get too far in the weeds into that process right now, but here's the third one that I'm in, and this one is a $7 put for 37 cents. And that one had, at the time that I placed it, had 89 days left on it. And that brought in 5.3%, 5.3% of the strike. So all of these are well above the 2%. That doesn't necessarily mean that they're better, because there's usually a reason why those options are a little bit higher priced. But nonetheless, that is the minimum that I use, and all of those trades meet that standard. So I want to camp out on this particular stock just for a minute, just so that you understand what is going on with this type of trade. Okay, so trade number one actually had a 28% annualized return on risk based on the entire length of the trade. In other words, if you turn around, you take a look at this trade, for example, trade number one is $9 put for 38 cents. That actually produced a 28% annualized return on risk. Okay, because I'm going to do it again at the end of 57 days, and I'll get to that here in a second, but I'm going to do it again at the end of 57 days. And so if I keep doing that, I bring in 4% every 57 days, it turns into about a 28% annualized return over the course of the year. Trade number two is a little better. It produced a 36% annualized return on risk, and then trade number three produced a 23% annualized return on risk. That is above average returns, obviously, right? 28% annualized return is well above the normal buy and hold in stocks. And so I wanted to show that for a second, and also point out a couple of other things given this context. I want to take a look at the break-even level for a second. Okay, now if you're going to sell puts, the break-even level is going to be the strike price, the strike minus the premium brought in. That's going to be your break-even level. And for trade number one, which was again the $9 put, brought in 38 cents, that means that the break-even point for that particular stock required the market to move down 32% within the next 57 days in order for that particular trade to break even. So as long as it stayed above a drop of 32%, I would make the entire 4% on the trade. Trade number two required a drop of 35% in order to reach the break-even level. And then trade number three, which I'm currently still in, it required the stock to drop 46% before it even hits the break-even level. So if it drops 45% from where it was when I got in at the expiration date, I will still make the entire, how much was it? It was the entire 5.3%. The market can drop 45%, and I will make 5% on this trade. That's the kind of probabilities that we're talking about. So there is, based on the combination of the distance that the market needs to move in order to reach break even, along with the amount of time that it has to move in that direction, those things combine to give us a probability of success. And trade number one had 93%, trade number two 91%, and both of those worked out. And then I'm currently in trade number three, and that is a 93% probability of success. And the closer we get to the expiration with the market not moving towards the strike, the higher the probability that the trade is going to work out. And this is assuming that you're going to hold the trade until the end, which you don't have to do, and I'll get into that here in a second. But let's talk about the max risk now. Okay, we know what has to happen in the market for us to reach a break even. Let's talk about the max risk on this particular stock and these trades. Number one, I sold a $9 put for 38 cents. That means that the break even level is $8.62. As long as the stock remains at or above 8.62, and by expiration, I will make money on that trade. Now, if the market goes to zero, so on trade number one, there's 57 days left. If the market goes to zero within those 57 days, I am technically at risk for $862 on that trade. What's the probability of the market going to zero? Again, based on everything that I've shown you so far, it's not even worth mentioning. The probability of that is not even worth mentioning. And obviously that worked out. Trade number two, the strike was, or the break-even level was a little bit lower at $8.21. That means that I am risking $821 in the next 80, I think it was 85 days, if the market that I was in went to zero. And what's the probability of that? Virtually nil. I mean, again, not even worth mentioning. It's a 0.000 probability of some point of some sort. So very, very low. And then trade number three, which I'm still in, and that one, the break-even level is at 663, which means that I have a $663 risk on this particular trade if the market goes to zero within the next 89 days from the date that I get into the trade. That's it. So you can do this with a really small account, but more importantly, I want you to see what actually has occurred with these trades, because this is very typical of how I approach this. So let's say I have an account of $862. That's I've allocated $862 to the first trade the first time. Well, that trade exited with 44 days. Exited in 44 days. It was a 57-day trade, but with 44 days left, I was able to take the majority of the profit out of that trade. Then trade number two actually exited in 71 days as opposed to 89 or 85. So that one exited about 2 weeks prior to the expiration. And then trade number three, there's a max hold period of 89 days. And if the stock remains fairly similar to where it is trading right now, then I'm probably going to exit this trade a couple of 3 weeks early as well. If the market moves up, I will actually be able to exit sooner than that. And all in all, what it does is it increases the overall annualized return. If I'm able to exit early, it increases the annualized return, and I'm able to get into another one sooner. And so in reality, on the original $862 allocation, I have generated a return of 16% in 204 days. And that's assuming that trade number three works out and assuming that it takes the entire 89 days for that to work out. That's what will have happened, is a total net of 16% in 204 days. Again, probability is that on most of these I exit early, and that is the probability. And so it's probably going to happen in less than 204 days, which means I'll be able to get into another one. Again, I'll be able to use that capital either to get into this stock or another stock. But that comes out to 28% annualized return. And it's a 28% annualized return on trades that carry a 90% probability of success or better. So this is a no-brainer, and we're not even done with the good stuff yet on this, because once you start to diversify, let's say instead of focusing on one stock, you have a $5,000 account, you're going to focus on 5 stocks. And once you start to diversify, you increase the overall probability of long-term success. And you can do this with relative ease. So what is the goal of this? It's simply to generate above average returns with a fraction of the risk. Okay, well, what is an above average return? Well, 12% is an above average return. And I'll talk about the stock market average returns here in a second, but 12% is almost actually double the average return of buy and hold. And to generate a 12% return on a $5,000 account consistently, all you need to do is average $50 a month. That's it, just $50 a month. And the example that I gave, the stock example that we just went over, is averaging $25 a month, assuming it takes the entire 89 days for this current open position to exit the trade. It will have averaged $25 a month alone over the course of the 6 months or so that it was involved in this. So that's all that has to happen. And so for $25 a month with one, guess what? You can average $50 a month with two. And so with a $5,000 account, if all you wanted to do is average 12%, you could do two of these and you could come very close to averaging 12%. Again, barring that the stock doesn't absolutely crater. In normal market conditions, you can do 12% with a fraction of the risk. Okay, now long term, stocks are up about, again, an average of 6.7% annually after accounting for inflation, with frequent 10 to 30% drops and an occasional drop greater than 30%. We saw it this year with the pandemic, a drop that was greater than 30%. But it immediately rebounded, by the way. But in normal market conditions, this is what's going to happen. And over the long term, you really can't expect much more than 6 or 7% after you adjust for inflation. All right, so if we take a look at 5 different stocks and we look at a 30% drop in 5 different stocks where the break even is beyond 30%, it's all the stocks still produce the entire profit on the trade. So as long as your break-even level is beyond 30% in that particular stock, or if you have 5 different stock positions, you're talking about a scenario where there doesn't have to be a move up, there doesn't have to be a stagnation. There can even be a move down all the way to whatever the break-even level is. We'll just assume it's around 30%, and you still produce the entire profit on the trade, and it has to happen within that time period, right? So let's take a look at trade 3. I talk about 30% and the probabilities of that, but trade 3 required a 46% drop just to reach the break-even level, and that produced a 93% probability of success. Well, what happens if the market actually does drop? What I talked about was being resistant to a stock market crash. Well, let's take a look at this as an example. If the particular stock that I'm in drops 60%, 60% from where it was when I got into the option. If it drops 60%, then the stock is going to be trading at around 492. And the situation produces a 25% loss on the risk. Now remember, the risk was $663 if the stock goes to zero. Well, the stock didn't go to zero, it dropped 60%, and it's now trading at 492. In this example, obviously it's not, but if it does at 492, I'd be losing $171. And $171 divided by 663 comes to 25% loss. So your risk on this particular trade is a fraction of the buy and hold, a fraction. And if you're doing two, let's say, for example, two on a $5,000 account, you're risking a fraction of your account, right? Because you're only risking 800, at the beginning it was $862, but now it's only requiring $663. But the $171 potential loss, if that's what happens in the market drops to that, would be actually less of a percentage based on the original amount that I started with, which was $862. For me to make the first trade that I chose to trade in that market in this series was $862 of margin required, or $862 at risk. And if you divide the 171 based on the original, you're talking about like 19%, not 25%. Plus, I've already had 2 profitable trades, so you got to add that into the mix as well. And so instead of $171, if you add the 2 profitable trades, you're talking about a net of $71. I would be down $71 after 3 trades if the market now on the 3rd trade dropped to 492. So that $71 loss on the original amount only comes to 8%. 8%. So the 25% loss here is if this is your very first trade, and on your very first trade, the market makes a drop of 60%. And this is the worst case scenario. A 60% drop, worst case scenario, produces a 25% loss on the risk allocated to it. That's what I call a very high probability of long-term success, because even if it drops 60% now, guess what I'm going to do? I'm going to sell an option that's even lower, right? So what's the probability of 5 stocks dropping 60% in similar situations? Let's say you have 5 similar stocks, 5 similar situations, or 5 similar stocks from the standpoint of price and the position that you're able to get, not necessarily 5 similar stocks from standpoint of correlation, but from the position that you're actually able to get. So you have 5 stocks that drop 60%, only produce a loss of $855 using the example that I just gave, so it's 5 times 171. If all 5 stocks immediately drop 60%, in a $5,000 account, you're talking about a 17% drop in your account. All 5 stocks drop 60% in a similar situation to what I just gave with trade 3, and you're talking about a 17% drop in a $5,000 account. This is what I call crash resistant. This is crash resistant. Stocks may crash, but my account didn't. Now, my account may be down, but it's probably going to be down a fraction of the stocks, or a fraction of the amount that the stocks are down. So I'm already creating a buffer, if you will, and a resistance within the positions themselves of seeing my account crash, even if the stocks crash. And a 60% crash is a huge crash. That is a significant crash. So that is, I cannot understate that enough. And if you have a bigger account, that's fine. $100,000 account, let's say trading 20 stocks instead of 5 stocks, because you do have to be realistic. How many of these are you going to watch, and how many of these are you going to trade? And actually, how many opportunities are there where you have 94, 95, 96% probability of success? Ultimately, if you plan on exiting early, which you should. But $100,000 account trading 20 stocks with similar risk-reward ratios. So if you get into 20 stocks and you allocate 5% of your entire account to each of those stocks, all right, so risking 5% meaning that if the stock goes to 0, that would then lose $5,000 in the account. So you have 20 of these stocks. If all 20 stocks immediately went to 0 after you got in, you would essentially be losing $100,000. Okay. However, if all 25 stocks dropped 60% and they were similar to trade number 3, which I just went over, you would be looking at a $25,000 loss in your account versus a 60% or $60,000 loss in the actual stock portfolio if you were to buy and hold. And again, all 20 stocks have to drop 60%, which means the stock market did crash at that point. It absolutely crashed at that point. And it has to happen on your first trade. Because if it happens at any time after that, after your first trade, second trade, third trade, fourth trade, you will have money, profits to further buffer that risk. And so again, this is what I call a crash resistant approach. Now, on the flip side, barring a across the board stock crash of 60%, This approach puts you on pace to conservatively generate around 25 to 30% annual returns in normal market conditions, and normal market conditions include 10 to 30% drops in the stock market. Okay, so, and I'm probably being a little bit lenient because we don't often have a 30% drop in the stock market, but 10%, 10, 15%, a little bit more common. And even in those scenarios, you're talking about high probability of making the entire return over the course of a year, 25 to 30% annualized return if you are consistent with how you approach this. Now, again, that's 25 to 30% annual returns in normal market conditions. And if all of your stocks crash 60%, that's the only time that you would start looking at a 25%, 25 to 30% loss. So it will be very, very rare for a 25% loss to happen, but a 25% gain can happen in normal market conditions. All right. So again, it is not difficult to beat the market. And if that bothers you, you can certainly be more conservative. Or if you're like, oh, I've never sold puts before. I don't, I've heard it's so risky. Well, I'm explaining to you the risks, right? So you should be able to see plainly that the risks are actually lower with this approach than buying and holding any stock, period. So if that bothers you, though, you can still be more conservative. And I'm going to just blow your mind here in a second. All right, so you can still be more conservative. So let's say you have a $100,000 account. Instead of targeting 25 to 30% returns because you don't want to risk 25% in a stock market crash, let's say you only go for 12%. Well, 12% return occurs by closing out an average of $1,000 in premium per month. That's it. An average. You're not going to do that every month, but you can certainly average it. And so I want to show you how you can do that with just that one single stock that I presented here earlier. I told you I wanted to focus on that one to kind of really explain this approach. You take this one single stock example given above or given previously, and you could trade 40 contracts. And over the course of a 204-day period, in reality, if it takes the entire $89 days to close out the third trade, it will have averaged $25 per month per contract. And if you have 40 contracts, then you're talking about averaging about $1,000 a month. Okay, and that's assuming, again, that the stock doesn't crash. And if it does crash, it might be something less than that. Or of course, there is risk. But assuming the stock doesn't crash, it's very high probability that you'll be able to generate around $1,000 a month just from trading 40 contracts. Now, what is the risk of doing that? What's the risk of doing that? Well, this produces a 12% return, and the risk, if the stock goes to zero, is only $26,520. The stock has to go to zero for you to now risk 25%. So you have almost no chance of that happening. And you're putting yourself in a very high probability of being able to achieve a 12% return or even a little bit more based on being able to exit some of these trades early. So you have a high probability of generating 12% return or greater with a 0.02% probability. And actually I'm being conservative there. It's actually a much smaller probability, but we'll peg it at 0.02, not 2%, not 0.2%, but 0.02% probability of losing 25% on your first trade because the stock goes to zero. Okay, just a very, very low probability. Or if the stock goes to zero at any time during the next year, what's the probability of that? It is very, very, very low. So obviously, though, if you add diversification to this process, and the probability ratios are even more favorable. So you can do it with one stock, but you don't want to put all your eggs in one basket, even if the probability is really, really, really high that you won't realize a 25% loss. So The stock goes to zero. That's the ultimate crash. You can't get any crashier than that. And you only lose 25%. That's the worst case scenario. Meanwhile, you're putting yourself in a position to make 12%. Point being is that hyper options can produce far above average returns at a significantly reduced risk to standard stock investment portfolios. That's what I stated at the beginning. That's what I've proven to you over the last 30 minutes. And it gets even better than that. I can show you how to increase your overall annualized return on risk. And so, for example, here's a trade that produced an annualized return of 73% on risk. And you can see I use the same concept. I'm not selling puts while the market is surging. I wait for the market to come down. I actually sold one here, and then I sold one here. So I was a little bit aggressive on this, and there's a reason I was a little bit more aggressive on this one. I explained this in my calls, but I'm currently in this one here, and the strike zone is way down here. The strike zone when I was in one here was up a little bit higher. I think it was a $9 put. And that one exited, and then the market came down a little bit, and I'm able to swap it, and I moved the strike zone down here. All right. So on this particular trade, I actually was able to produce a 73% annualized return on risk. And so there are ways to increase your overall annualized return and to reduce your overall risk. Even if the market goes to zero on this particular trade, my risk was a fraction of I believe it was somewhere around $850 was the risk on this. And in reality, the risk was about $210, not 850, but 210. I don't want to get into the weeds on that. I just want to point out that there are ways to dramatically reduce the overall risk that will also increase your efficiency of being able to take these trades. Now, if you want to really stack the probability of making money in your favor, I'm talking astronomical odds, I mean like really stack the probabilities in your favor, you can. And this is how. Anything requiring a move down of over 50% to reach the break-even level is what I call hypersonic options. So if the move down just to reach the break-even level is 50% or more, that's what I put into a slightly different category, and I call it a hypersonic option. Or in other words, it gives me a super high probability of success. And the day of this video, I actually made a trade where the break-even level was at a move down in the stock of 67%. That's the break-even level. The stock can move down 67% before it even reaches my break-even level, and that calculated out to be a 98% probability of success. Now, in order to do that, I have a little bit smaller annualized return on risk at 11%, but that still beats the market. So I have a 98% probability of making an annualized return of 11%. Who can say that? Who can say that? This is one of the only strategies that exist where you can make these kind of statements. And it's because the stock has to move down 67% within the allotted time of the option in order to just reach the break-even level. All right. Now, that's really crazy. But if you want to go really crazy, I mean, like unbelievable, you won't believe what I'm about to show you, crazy. There are even higher probability opportunities. And this is going to blow your mind. In fact, if I didn't make the trade, if I wasn't filled on the trade, I would have doubted anybody telling me that it could be done. But I've done it, and I did it, and I will show you what it is. Not in this video, but for those that are interested and want to climb aboard, I will show you what this trade was and is, and you can still get into it, by the way. But for example, I made a trade the other day that returns 21.9%. 21.9% on risk with a 99.7% probability of success. 21%, almost 22% return, actual fills, and a 99.7% probability of success. And those are not my calculations. Those are any third-party calculations that are giving me the probability of success. Particularly on this one, I used IB, and you can go to any of the sites that provide this kind of stuff, and you can confirm 99.7% probability of success to make a 21.9% return. The stock has to move down 95% just to reach the break-even level. Now tell me you don't want to know what this trade is. I know you do, because I cannot imagine anyone not wanting to at least get their feet wet, because this is not some no-name company. This is a huge, huge company. Everyone will know what this company is, and anyone with any account size can put this trade on. That's how crazy ridiculous this is, and it is so super simple. Anyone with any size account can put this on. And I am in this in a fairly significant way. But these are opportunities that you need to know about. Most traders don't even realize that these opportunities exist. And like I said, this logic is one that has been proven by me over and over and over and over and over again. Does that mean there are no risks? Of course, there are risks. The stocks can crash, and they can crash and create losses. But I've shown you the worst case scenario, and that's the stocks going to zero. And it's still a fraction of the risk of the buy and hold, while putting you in a position to make far better than the average stock market return. So if you're interested in these types of trades, and I can't imagine anyone not being interested in this type of trading, at least on a small scale, to get your feet wet and learn how to do it, and then start allocating a little bit more of your portfolio towards this, I provide hyper option live trade webinars twice a month. I don't need to do them weekly because they're not weekly options. And we're not getting into 20 trades at a time, right? So if you have $100,000, you're not going to get into 20 trades immediately. You'll scale in eventually. So we'll talk about opportunities that exist twice a month, every other week, and I'll show you how to determine stocks to consider by showing you the stocks that I'm considering. I'll show you how to determine the expiration months that I consider and why, by showing you the trades that I'm going to be taking. I show you how to determine strikes. I show you how to determine the limit orders. I show you how to reduce the overall risks, and in many cases that is possible. It's not absolute, but it is possible. I'll show you how to properly diversify. I'll show you how to increase overall annualized returns, and I'll show you how to maximize the efficiency on these webinars. They are tremendous, tremendous help tools, plus they provide a lot of great trades. So this is definitely something that you want to consider. I also show you all the details behind generating above average returns with a fraction of the risk of standard stock investments, which is pretty much every trade that we get into. In addition to that, I also give you 5 to 7 exact trades in every webinar. So we go through, I show you the stocks that I'm looking at, I show you the strikes, the expiration months, why this expiration as opposed to this expiration, why this strike as opposed to this strike, etc., etc. And I'll give you 5 to 7 exact trades in every single webinar. So you can choose to take 1, 2, all 5, all 7. You know your situation better than I do. Plus, I also give you official 1 to 3 hypersonic option signals each week. And remember, hypersonic option signals are the super high probability trades, including the hypersonic option trade that I recently took, again producing 21.9% return with a 99.7% probability. So I include that. You'll see what it is. But you'll get 1 to 3 of these hypersonic option signals every week. Now, they may or may not be filled. They may or may not be executed, but the signals are there and they're working, and you can certainly choose to put them on. So if you're interested in this, I would strongly, strongly suggest that you sign up for this. One more thing that I'm going to include in this package is access to my Hyper Options and Hypersonic Options trade finder in PDS Trader. Now, in the signals, I give you the ones that I've determined that I'm going to be taking. But the trade finder kind of gives you, kind of just spits all of the different markets that are available based on the value of the options, the strike price distances, etc. And so it'll kind of let you see what's available out there, in addition to the actual trades that I'm taking. And as a reminder, with it, this is where I get mine from. I look at PDS Trader, I have it do a search, and then I start narrowing down which trades I'm actually going to take from that list. So all of the signals that you get are pretty much going to be found in the trade finder as well. Now, there is an introduction rate if you want to get involved in this. I make it where everybody can afford it. This is definitely something where you want to learn the approach. Even if you have a super small account, it may not, a super small account is going to be a little bit slower to grow, but you're going to learn a lot in these hyper option live trade webinars. And so for a limited time, very limited time, because obviously I don't want a bunch of people taking these trades. I'm going to give you 6 months access, and it's worth far more than that, but I'm going to give you 6 months access to everything you see here for $4.97 subscription. And then if you want to go out as long as 12 months, I'll give you even further discount at $7.97, again, as a reintroductory price of the hyper option package. So again, this is the trade that I just told you, the 21% winning trade, or 21% return with a 99.7% probability of success, is worth the entire cost of this package. So I would strongly suggest that you get on board, give Spring a call, 918-203-7547, and I will see you on the next Hyper Option call, which, by the way, is every other Monday. So the next one will be this coming Monday, and I will see you there.